Hey traders, Steven here. It's Friday after the close. Really want to go through and take some stock of the overall market, just to really kind of dive deep a little bit. I'm looking at the Nasdaq now. The Nasdaq, you can see, really didn't have quite as bad of a day as the S&P 500 did, but you can see it's still hitting some major resistance. You got this cluster right here of the 50, the 20, and the 200 day, really all just kind of creating what looks like a major resistance zone. You know, what I'm seeing down here, since this pullback has happened, a lot of distribution here. I'm going to kind of scroll up here. A lot of distribution that's been coming in the market, um, down days and above average volume, or down days and volume above the prior day. And what I'm also seeing is on the bounces, right, on the green bars, the volume is just lower. So that's definitely not a good sign. Now the S&P 500 is faring better, but you can look down here. The Nasdaq has really been underperforming the S&P 500 since really the beginning of December of 2015. So really not an ideal situation that, when you're in a healthy bull market, you want to see the Nasdaq outperform, because that's typically where a lot of the earnings and sales growth come from, right? Your technology companies, typically you're just higher growth companies, and that's just hasn't been happening. Now, does that mean that the market can't move higher? No, absolutely not. That, the energy and the financials that are heavily invested in the S&P 500 can definitely push the overall market higher, but this is just kind of one gauge I look at. Now, when I look at the market, you can see we've really had a nice trend. The Nasdaq is up probably about 18% since the bottom, right, to the peak over here. So you had this really double bottom, right, a breakout. And this is one reason why I try to put rules in place to really keep me in the market, because you can see the market broke out right here, and this is where I started initiating positions. I was in cash, all this. We had a failed breakout right here that I just tested, but it failed, so I went back in cash. But the market broke out right here, so I started really initiating my positions. And I'll be honest with you, right, this candle right here where it really just gapped down in the morning, I really thought the uptrend was going to fail, but by the end of the day, it really had an upside reversal, a nice candle, and it just showed a lot of strength. So sometimes at the beginning of the market cycle, the market trend, it might take a few days or even a couple weeks for the market to really find its footing, and then it just takes off like it did. So I got in right here, I got out right here. I made some pretty good money on this trend, and that's the important thing. I try to create rules to keep me in the market as long as I can, because I know for a fact, I know a lot of traders, a lot of smart guys were right at this W right here, were initiating short positions, right? Because they thought this would hit resistance. Well, the Nasdaq broke through that, tested the 20-day here, and here. So it's kind of rare that, I'd even say it tested it 4 times with this candle right here. It's kind of rare that the market will test the 20-day moving average 4 times in a trend. Typically it tests it 2, and then on the third one it fails, but it really was a strong trend. So I made some pretty good money on this trend. And then when it started coming in trouble, I got out. But what I think is going to happen is I'd be surprised if the market just completely rolls over right here, but I think we're going to get into kind of another trading range. Does it break out or does it break down? I don't know, but you really got to be careful when you're buying pullbacks, right? You want to make sure you're buying pullbacks in the strongest sectors, right? And we're going to talk a little bit more about that in a minute, what sectors are the strongest. But I don't mind this, right, this downfall effect, because I'm in cash way up here, right? Typically when the market breaks the 20-day moving average, I'm out, or I'm in a majority of cash. So I don't mind this, I don't mind this, I hate this, right? Because within trading range, there are a lot of failed breakouts. You had a failed breakout right here, and then the market completely rolled over. I'm afraid that's what we might end up over here, but we're just going to kind of pay attention. But I know, the Nasdaq is really underperforming the S&P 500, so we're just going to continue to watch that. Now, if we look, the daily chart looks better than the weekly chart. If we look at the weekly chart on the Nasdaq, It really just looks like a massive trading range, 22% trading range going all the way back to mid 2014. Just really looks like a topping formation because you can see, and you go all the way back to 2013. The 50-day was above the 200-day, and now it's really, starting to live below it. Really is looking weak. And if this is a topping formation on the weekly chart, it definitely looks like a topping formation. It takes time, right? The market typically doesn't go straight up and go straight down. It's going to take time for a major bull market to mature, and it's going to take time for a bear market to mature. So I'm not calling for a bear market, but I'm saying this looks like a topping formation to me because you have this 50-day moving average. It's very indecisive. It is really not consistently just punching through and making some progress above that 200-day moving average, right? It goes up, it goes below, but it really looks like for the most part we're having a series of higher lows right here. So it's just really, it doesn't look good on the weekly chart. We're going to continue to pay attention to that. On the S&P 500, definitely looks better, although we had some weakness today. It definitely looks like more of a trading range in the S&P 500 than it does in Nasdaq because the Nasdaq has pulled down harder. But you still have the golden cross that happened a few weeks ago, and now the 50-day moving average cracked in the S&P 500. So it's probably going to be a little bit better. I could probably redraw this trading range, but it's probably looking like it's going to be a pretty better correction. I think this really 2010 area should be a level of support for the S&P 500, which is 3% away, but that doesn't mean it's going to happen. But it's probably going to test that. It might bounce, and then it might take another leg down. But we'll really wait and see. I'm not seeing anything in this pullback. I'm not really seeing anything right now that is just really out of the ordinary to make me feel that we're going to roll into a bear market, but we're going to look at some things, and that's just you just never know what's going to happen, right? You got a trading range. You think it's a nice sideways. It should break out, and then it breaks down. So that's why we really just want to take it day by day. And you want to be careful when you try to make a bounce play and when you try to play these trading ranges. If it doesn't bounce, you need to immediately get out. And that's kind of my rule. I buy stocks, I buy ETFs. If it doesn't do immediately what I thought it was going to do, then I'm just getting out, right? I made an investment earlier today. It didn't do what I thought I was going to do. I got out. Not really with a loss, but the expectation. Sometimes when a stock or an ETF doesn't do what you think it's going to do, and then all of a sudden you're kind of scratching your head, which way is it going to go? It's really just safer to get out and move on, and just let the move mature. So this is the QQQ, and I trade the QQQ a lot, and I trade the leverage, TQQ. Definitely weak with the Nasdaq, right? Technology is weak, but I wanted to kind of show you something. You can see right here how the QQQ versus the S&P 500 has really underperformed since the S&P 500 since the beginning of December. It's underperformed the Russell 2000 for the most part since December, although it's starting to perk up, right? And then you have the QQQ versus the Nasdaq Composite. So this is the Nasdaq 100 versus Nasdaq Composite is starting to perk up, right? And this right here is what I like to see. I want the Nasdaq 100 to beat the Nasdaq, but right here it's pretty much flatline, right? So that really means nothing, but for the most part the trend is down. So that just, to me, that just continues to show me that there's overall strength in the energy and financial and the more broadly diversified market, and there's less strength in the technology sector. I'm just going to kind of go through some charts. So, I use price and volume first. I use price first, and then I use volume, right? And I have rules that really just keep me in the market as long as I can. I use secondary indicators. I really don't make direct trading decisions. Like, I don't look at overboughts and oversold and then say, okay, it's over bought or oversold, so now I'm going to buy something. But sometimes I use it as really as secondary indicators, meaning if I'm looking for divergences and if the market's moving up, but the breadth is starting to roll over, that's not going to make me go out and sell everything, but because the breadth can really deteriorate quite early before sometimes the major tops are put into place. But that's going to tell me I'm probably going to hesitate putting on any new positions until the market and the breadth has a come to Jesus meeting, meaning either the breadth gets better or the market, meets the breadth. So right now I'm looking at a chart with, you got the stocks above, S&P stocks above the 20-day and the 50-day, and I got the 200-day down here. But right now, breadth is deteriorating with the pullback, but it really went from, and you can look over here in the thumbnail, 95% of the S&P 500 stocks were above the 20-day, and now only 40%. So, we're in a correction. That's not necessarily bearish. That's kind of to be expected, or at least, according to my analysis, right? It's not like 10%. I really more pay attention to the 50-day EMA or the 50-day moving average because, that's more of an intermediate term type of trend. And you went from 91% of stocks to 54%. So you still have 55% of the S&P 500 stocks above its 50-day moving average. To me, that's not just screaming that the breadth is just significantly deteriorating. I would expect for this to happen with whether it's a minor correction or a pretty good correction. So until we get like way down to 20 or below 40, it's not really a bearish signal yet. That doesn't mean that can't happen, but I want to show you something. Looking at the S&P 500 breadth back in 2009, this is a pretty good chart, and this is one way you can use breadth to really kind of give you a guide to what's happening in the market. Right here, you have this nasty bear market. In late fall of 2008, the S&P 500 was at 741. It made a massive bear market rally and then undercut the low, right? The bottom, 666, March 9, 2009, was the bottom of that bear market. Well, what happened, if you look underneath the hood, the breadth indicator right here for the 20 and the 50-day, it did not undercut the low. So on this, you have the market took a leg down, and then it came down, and the market undercut the low, but the breadth stayed above the previous low. And what that's telling me, when you're in a heavy bear market, and you can use these in shorter term corrections too, but when you see this positive divergence happen, now that can give you a pretty good indication you're probably on the last leg down. So you can see the breadth, the market makes a lower low, but the breadth makes a higher low with the 20 and the 50-day. So that's telling you got to be close to a bottom. So it's just a tool. It's just a tool. I don't, go in and see, 10% of stocks or below its, 20-day moving average. That's a buying opportunity. That's not what I look. But again, I really more use it as a yellow flag. If I see breadth deteriorating and the market's still moving up, I really just keep myself from making new purchases. So, by the way, my kids are at home, so you're probably going to hear a couple cute little kids in the background. It definitely happens. The dollar, I've been talking about the dollar. The dollar is the most important chart to me in the stock market right now. What happens to the dollar? Because a strong dollar is going to push commodities back down. It's going to push gold back down, which is going to push, all the miners. It's going to push, oil, I think, back down. So just complete commodities, right? Commodities and the dollar mostly are inversely correlated. So you have this massive run in the dollar, and this is the UUP ETF, by the way. And then you have this big topping formation. And you had major support at the 24 area, then all of a sudden that broke, right? You can see right here that broke, support broke, and now it's trying to come back, and it's really trying to test. You see this candle right here, that 50-day moving average, and it'll probably find resistance and continue to head lower. I would think that's a good thing because right now I believe the only thing that's holding up the S&P 500 in the market is energies and commodity-based stocks. If you take those out of the picture, the market weakens significantly. So I think the dollar, really what the dollar does, if the dollar gets strong and just continues to, head higher, I think it's going to be pretty bad for the market just because of where all the market strength is right now. It's in commodities or in something that is directly related to commodities. So you probably need a lower dollar for that to hold up. And this is a chart I'm really, really paying attention to. Now this is the iShares Global Gold Miners RING. I use RING ring instead of GDX because I've compared them side by side. And over the short term, over the long term, RING is really just slightly better. It just performs slightly better. But you can see this massive run from 510 all the way up to 1150. That's an amazing run. This ETF more than doubled. You can kind of see how it stair-stepped its way higher. The miners are really looking toppy, right? To me, right? It's really starting to get sloppy up here. Indecisive. It's still finding support of the 50-day or the 20-day moving average, but for me to get on board, I own some things that are indirectly related to miners. Like I own some emerging market countries. I own some metals. But I've made a little bit of money on miners, but I took my profits quickly. But, for me to get involved in a miner ETF, I really think it needs to test that 50-day moving average first. So it's probably about 12% above this area. For me to want to buy a pullback, I would need to see this support tested and successfully, a successful bounce or a successful hammer printed right there, just because it's such a parabolic move. It hasn't, that pullback hasn't happened yet, but you can kind of see how it's really just stair-stepped its way higher, and it stair-stepped its way higher. It finds support at that level, and then it goes up and it breaks out and it finds support at that level. So what's going to happen from here, I don't know, but this really looks sloppy, and sloppy means indecisive. So I'm really going to keep my eye on the miners, but if you haven't jumped in miners yet, I think you're going to be able to get a better price within a couple weeks, because when they fall or when they correct, they're going to correct pretty good. So looking under the hood a little bit further, now I drew this at the beginning of the day, but you can really see that at first there was it's funny because sometimes these divergences, they can correct themselves quickly. So you see, this was before the day I drew this, the S&P 500 was slightly moving higher, and this black and red line, this is the discretionary versus the staple stock. So when this is trending lower, that means money is moving out of aggressive areas into conservative areas. So you can see since the S&P 500 topped, money has clearly been moving into more conservative areas, which is to be expected. So this isn't groundbreaking or anything. So what I'm looking for, and there for a while, the S&P 500 was moving higher, and this continued to trend down, which was telling me something. Even though the market is trying to bounce, S&P 500 is trying to bounce, money is still rotating into conservative areas. And then, of course, that corrected, and the S&P 500 really took it on the chin today. But this is just to go show you, money is rotating into conservative areas. So before I would consider, putting more capital into aggressive areas, I want this to turn up, right? I want something like this to happen where the market's moving lower and this is starting to curve up, meaning the institutions and the mutual funds are starting to buy the more aggressive stocks. Now, if you look further down here, you have the TNX, that's the treasury yield. If you look in the thumbnail, the treasury yield has been going down, which isn't a good sign. It means that bonds are being bought, which is pushing the treasury yield down. So institutions are investing their money into treasury yields, which is, again, that's kind of to be expected. So no real groundbreaking kind of breakout there. You have the percent of stocks in the New York Stock Exchange above its 50-day moving average. So that peaked back in mid-April, right? And about 90%, and it's now all the way down to 55%. So I'd say, we're still not in that, really bearish breath stage, but it's deteriorating, and I'm going to continue to watch it. And then you have the Russell 2000 versus the S&P 500. What that means is when the line is moving lower, the S&P 500 is outperforming the small caps, And again, that's not what you want to see. You want to see the more aggressive stocks perk up, outperform the large caps, because that's what happens in a more healthy environment. So let's go kind of look at a little sector summary just to kind of see. You can see that healthcare was up. Technology was surprisingly strong today, but you got materials towards the top. Energy really just got whacked, which might not be a bad thing, because I think energy stocks need a pretty decent pullback, because even the strongest sectors need a pretty good pullback. They're entitled to one. But you can see in the last week, the top two sectors are utilities and consumer staples. Your staples are your cereals, your cigarettes, your beer, recession-proof type stocks, right? People are going to buy cereal no matter what. So a lot of your dividend-paying stocks, and you have your cyclical stocks down here, so there's definitely a bearish tone as far as the sector rotation in the last week. Now, if we go to last month, there's still a bearish tone, because you can see utilities are still towards the top. But as far as and consumer staples are up there, but you have this energy that's still up here. So you have these. I don't think that this year is going to be a strong year in the stock market. At least in the first half of the year, I think the market really needs more time. And sometimes you have interesting periods of sector rotation where for the last several years, you have technology and biotechs was really leading the bull market. Well, now they are incredibly weak, or at least biotechs has been incredibly weak, and technology starting to weaken. And does that mean we're going to roll in a 50% correction? No, but that means we could have a pretty good sector rotation where leading the next bull market could be energy, right? It could be financial. So it's really just something to pay attention, but you want to make sure you are allocating your capital towards the most strongest sectors. Surprisingly, the energy sector, coal, which has really got me scratching my head because Peabody went bankrupt. Coal is still the strongest. Integrated oil and gas is right up there. So, if you want to look at coal stock, Suncoke, that's the number one stock in the sector, as far as I'm concerned. I've looked at the chart. The chart looks pretty good, right? It kind of grinding its way higher, had a nice little cup right here, broke out of that, broke through the 200-day moving average, had the golden cross. It's starting to pull back in. It's made such a monster move. I don't know if I'm going to buy a 20-day bounce. I might more buy a 50-day bounce, but it's looking like a pretty strong stock. So you have these natural resources too. You really want to buy from a relative strength standpoint. You want to buy the strongest stocks in the strongest sectors. And Suncoke, at least if you're going to focus on coal, is looking pretty strong. Now, you have some other oil and gas stocks right here in the last month. And I don't know these stocks, but I know ExxonMobil. So ExxonMobil is, that's a bellwether. That's kind of the cash cow right there. So, I just kind of want to look at that real quick. Man, it's just been grinding its way higher. It almost looks like the miners just absolutely took off. So, again, I think that if the conclusion, when we have these pullbacks, I think you need to continue to buy pullbacks on the strongest sectors. Now, when I say the strongest sectors, I mean energy, oil and gas, right? Whether it's an ETF or a stock, you really need to look at that. But I also think that if the bottom is really put in commodities, and let me kind of pull up a commodities ETF just to really show you what has happened. Let me kind of look at the weekly chart, and let me look at the last 10 years. Commodities really topped all the way back in 2008, but it also kind of made another top back in 2011. Most of the commodities topped back here. You had your gold, and emerging markets have really fell off a cliff since 2011. But look at a lot of these volume spikes that are really starting to cluster together, and we haven't seen that in a very long time. That's money moving into commodities. And when I see stuff that starts to happen on a chart that I haven't seen in a very long time, I really start to pay attention. So I think that you're going to do very well over the next 2 to 3 years if you're looking for some long-term holds. One, to really continue to focus on energy and buy some pullbacks and some high-quality ETFs or stocks. Miners, you definitely need that to correct probably a little bit more before I would consider jumping on board. But I continue to beat the emerging markets drum. I think it makes sense to look at, because the S&P 500, the GDP growth is absolutely nothing. The S&P earnings are shrinking for most of the S&P 500 companies. You have to go where the growth is, right? So I know this isn't where the growth is, but something that has popped up on my screen, it almost makes me chuckle talking about. But Greece is the number 3 ranked ETF out of 250 ETFs, commodities, everything that I look at. It's the number 3rd ranked on a relative strength basis in the last 9 days, and it's been trading in this channel. But look, it really is starting to break some key pivots, and it popped above it and it's starting to break through. And I would think it'll test this 750, 775 area. But when you have these investments that have been in a bear market for a very, very long time, and then stuff starts to happen, like look at this massive volume in GREK, and then it starts to just beat everything on a relative strength basis. So you got volume, you got relative strength, and then really if you go back and look at a long-term chart, this thing was once at $25 and is now at $8, right? So again, I know Greece is kind of comical to think about, but an investment is an investment, and when it's beating everything else, I'm going to pay attention. Russia is also a very interesting play. It's very oil and energy related. It's been in a borderline depression. I want to go back and even look at a longer chart. And I know no one likes Putin, right? But like I said, an investment is an investment. Look at this. It was once 28, is now 13, so it got cut in half. But again, actually, let me see if I can look at a better chart and go to the kind of the 6 years. So it's been living below its 40-week moving average for a very long time. But I mean, it's starting to clear pivots, and there's someone stepping in and accumulating these ETFs at a massive rate. That's not your mom and pop. Excuse me, let me scroll this up. That volume, that's not you and I. Some institutions are stepping in and seeing value, and especially if energy just turns around, this is really something to pay attention to. So again, I'm talking about buying pullbacks of very, very strong, and I'm just really trying to open your eyes to stuff outside of the U.S. because the reality is the stock market isn't the best every single year, right? There are other investments, and if you're really looking for outperformance over a long-term period or even a 1, 2, 3, 5-year period, some of these things that have been beaten up that are commodity related, and I would say Russia is commodity related. I would say Greece is not, but I would say Peru is. Look at this spike. This is an ETF, right? Went from 17 to 31. It's crazy what has happened here. I'm going to kind of go to a daily chart, and let me kind of break down the range a little bit. Oops. What happened there? Let me try to refresh that. But yeah, look at the daily chart. So again, this wasn't above. You had that death cross back in late 2014. You had the golden cross in 2016. Now this thing is way extended, but these emerging markets that can literally be up 50, 75% in a single year. What I found based on my own studies is they can be up 50% in a year for an average for 6-7 years in a row, just because they're not as developed, right? Their stock markets tend to get a little bit euphoric, but and sometimes it's a little bit harder to hold, so you might want to put a smaller piece into it. But again, you really have to start paying when any investment, whether it's a stock, ETF, country, commodity, whatever, starts to do things that it hasn't done on the chart in a very long time. That's really when you need to pay attention. So open your eyes a little bit. There's a world out there full of investments that are absolutely been beaten up, and most commodity related have been beaten up since 2011. So, I wish that, you have a great investing 2015, but again, you're always going to hear me say, focus on the sectors that are the strongest, focus on the countries that are the strongest, because they're not typically just the strongest for 90 days, right? They're the strongest for, 2-3 years. And that's what really creates that alpha in your portfolio. So I hope this was helpful. Let me know if you have any questions.